here's how to use dollar cost averaging the right way. Guys, dollar cost averaging is a really cool investment strategy that allows us to take advantage of market prices and maximize our chance of entering at a favorable price. Taking advantage of market prices seems easy, right? So it seems like, okay, I want to buy low and I want to sell high. The concept itself is not that complicated. We all know that we want to sell assets or securities for higher than what we paid for them. So the best strategy, in my opinion, to use that allows us to maximize our chances of buying at the lowest of lows is to use something called dollar cost averaging. Now, you may have heard this term get thrown around, especially with today's crypto hype. Everybody's investing in crypto. Everybody seems to have their own little strategy on how to do it. Now, early on in my career, I did not like dollar cost averaging. I was like, oh no, I could totally time the market. I can use my technical analysis skills and identify when the market is about to turn around, enter at the lowest possible price and ride it all the way to the very top and get out at the top. However, that's all theory. It doesn't actually work like that in the real world. And the thing is that even professional stock pickers and chart analysts cannot time the market perfectly. The market has a mind of its own. The market always moves however the market wants to move. And it becomes very, very difficult for us to identify when those entry and exit points should be. So, a good strategy that we can use is called dollar cost averaging. And what dollar cost averaging breaks out to be is simply buying the same security or asset at a regular interval, and you buy the same amount each time. It doesn't mean like, let's say for example, we're talking about stocks. It doesn't mean buy the same amount of stock every time. It means you're investing the same amount of money each time you buy it. Now, here's what that might look like. Let's say we're buying shares of a company, and shares are right now, let's say they're $100. And so we've committed to investing $1,000 every single week. So for $100 shares, $1,000 investment is only 10 shares. So, okay, we want to buy 10 shares, let's say on a weekly basis. We want to invest $1,000 on a weekly basis. So this week we're going to buy 10 shares. Okay, great. Well, let's say something crazy happens with the company, and next week that share price is down to $50. Well, if it's down to $50, we're still committed to investing $1,000, right? So don't get confused there. It doesn't mean still buy 10 shares. That doesn't really help you too much. But what we want to do is invest the same amount, and it has to be at regular intervals. We want to keep as many things constant as we possibly can, which maximizes our chance of riding that big wave up. So now $1,000 with $50 shares means we're buying 20 shares. So last week when shares were priced at $100, we bought 10 shares because that's our $1,000. Now this week, because they're down to $50 a share, now we're buying 20 shares and we're still spending the same amount. So note that we're not changing the amount that we're investing, and we're also doing it weekly. So let's say every Monday you decide to invest $1,000. Well, make sure you're investing every Monday. Don't switch it up to Tuesday or Wednesday or Friday, because that changes your interval. You want to keep those two things constant. Number one, the time period when you're buying. And by the way, dollar cost averaging can be used on a daily basis. This doesn't have to be weekly. Some people do it monthly, some people do it weekly, some people do it daily. And some of these platforms will actually allow you to set something up called a recurring buy. And so this is basically just dollar cost averaging. So every single week you're investing a set amount of US dollars into whatever that asset is that you're investing into. And you could do this with cryptocurrency, you could do it with stocks, whatever it is. Now, you could probably get a little bit more accurate and potentially better results when you're doing it on a daily basis. But if you're doing it on a weekly basis, you're still taking advantage of those moves for the most part. This basically protects you from two things. Number one, it protects you from being too late when it comes time to buy, so overpaying for assets. So let's say that same stock price, instead of being $100, it pops up to $500. And you were like, oh man, I thought it was gonna go down to 50 and I was gonna buy, but it didn't go down to 50 and it went from 100 straight to $500 or $1,000 per share. Well, now price has likely plateaued. So there's probably a big boost that happened in price. Price just ran up, had a massive bullish run, and now it's plateaued. And okay, well now if you buy, chances are that you're going to be overpaying for that share, and the chances of price coming back down are they're significant, right? We're no longer in such a strong position because price has already popped up and now we're buying at this elevated price. Price is already up here and we're just hoping that it's going to continue. So it's much better to consistently buy because number one, it protects us from overpaying. Number two, it maximizes our chances of buying at the lowest price possible. Because when that stock comes down to $50, I'm investing into it. Now, I personally do not invest into stocks, but I use this strategy with other things as well. I can use this strategy with cryptocurrency. I can use it with other investments where I have a periodic buy set up and price fluctuates, right? Maybe I'm investing in gold. Maybe I'm investing into some sort of luxury assets like maybe watches. If I know that watches are fluctuating in price, there are certain brands that really fluctuate in price. And so if I'm buying consistently, I can actually dollar cost average into gold, into silver, into other precious metals, maybe into crude oil for the most part, until you've really learned how to dollar cost average correctly. And from there, you can start building out your strategy and applying it to things that are in the real world. Some people use this strategy with real estate. It's a very large scale dollar cost averaging, but it's still dollar cost averaging because it's very hard to time the real estate market. We never know when it's going to hit the top and when it's going to come back down. And so if we don't know where the top or the bottom is, if we're always just buying houses, let's say we plan to buy one house a quarter or one house a year, right? So if we set some passive income up for ourselves where we're producing enough money to be buying a house maybe quarterly or annually or maybe even monthly, then we're dollar cost averaging into real estate and we don't really care where the real estate market goes because it tends to trend upward. So the value of real estate tends to trend upward long term. I'm always buying new real estate and I'm bringing my average purchase price down because I'm buying when it's high and I'm buying when it's low. I'm buying in the middle. I'm always just buying houses, right? The likelihood of me being profitable overall is very high. I'm dollar cost averaging into physical assets. Dollar cost averaging is a really cool strategy, especially if you learn how to apply it correctly. There's many different ways to do it, but you have to make sure two things. Number one, your period is constant, and also the amount of money that you are investing is constant. Because if you start fluctuating that, for example, let's just play around with the amount that we're buying. So let's say we bought those same shares, those $100 shares. We bought $1,000 worth this week, and next week we were planning to buy only $200 worth. Well, if next week the price of that share went down to $50, we're only buying 4 shares. And now we've kind of missed out on that opportunity because we invested all the money up front at $100 because we thought it was going to go up. But guess what? Next week it went down and we could have taken advantage of that opportunity, that low buying opportunity, that discounted price on that stock, but we didn't have enough capital to deploy. So it's always important to keep that amount constant. And so in that scenario, if we have the $1,200 to play with for 2 weeks, I would separate it out and do $600 this week and $600 the next week. And that way, that number is constant and you're bringing your average purchase price down just to maximize your gains. All right, guys, hopefully that was a helpful explanation for you guys. Make sure you like, comment, and subscribe, and I'll see you all in the next video.